Hey friends, it's a beautiful day to be a long-term investor. Today we are talking about the best high dividend, high growth ETF that you've never heard of. It is DIVO. We're going to talk about it right now. It is the Amplify CWP Enhanced Dividend Income ETF. They target owning high quality, large cap companies with a history of dividend and earnings growth, along with a tactical covered call strategy on individual stocks. DIVO's portfolio is strategically designed to offer high levels of total return on a risk-adjusted basis. This is in no way, shape, or form an advertisement for DIVO or this company, and I'm not being compensated by this company in any way. It is just a simple review. Okay, you've heard me talk about SCHD. You know it's one of my favorite dividend growth ETFs. I think it's one of the best in the world, but this one is really interesting to me. I like this approach, owning very high quality dividend growth companies. They keep 20 to 25 stocks, so it is a little bit more concentrated, could be a little bit more risky. The management here, it's actively managed. The managers really matter. And so if you don't like that, this isn't a fund for you. And they use a tactical covered call writing strategy, meaning they do it on an individual stock basis and they don't have to have covered calls on the stocks. They only do it when volatility is high. That brings in some opportunities for the active managers to either outperform or underperform. That could be riskier or it could lead to better performance. And so this is what they look for with DIVO. They look for capital appreciation. So you do have the opportunity for those positions that they own stocks in. Those can go up and you can get upside in the price of the fund. Then they look for a 2 to 3% dividend payment from the stocks that they own. And then they look to earn another 2 to 4% estimated annual premium in dividends from the covered call writing strategy. And so if it works out, there's a potential for great returns here. This is why I like DIVO better than some of the systematic or the QILDs of the world. They say most investment strategies that implement covered calls utilize a systematic approach, writing them on every position automatically. We believe that knowing when to and when not to write covered calls is the key to success with this vehicle. Based on market observations and income targets, we use a rules-based set of triggers to identify the best covered call opportunities on high-quality blue-chip stocks. So they look for volatility, opportunities to write covered calls when the VIX is at 15 or higher. When volatility is higher, you get paid more in a premium to sell calls. That's what they're talking about. And then the premium, they look for call premiums that yield 2 to 4% on an annual basis. That's how they're trying to up that dividend income. I'm going to compare this to SCHD at the end and tell you which one I like better right now. So stick around to the very end of the video. All right, here we go. DIVO versus SCHD. You can see this was started, DIVO was started in 2016. And this one was started in 2011, SCHD. Okay, you can see from Seeking Alpha, SCHD gets better scores across the board. And here you go. You got DIVO at a 4.75% trailing 12-month dividend yield and SCHD at 3.22. The average yield has been 5.99 for DIVO and 3.08 for SCHD, with a 2% 3-year CAGR dividend growth for DIVO and 14% for SCHD. So it is doing well there. But then over 5 years, DIVO's at 22% versus SCHD at 12. Okay, again, SCHD has 9 years of history. DIVO only has 1. That's another reason you might choose SCHD over DIVO. Okay, here's another big difference. DIVO has 29 holdings. SCHD has 103. DIVO has 52% of assets in the top 10. SCHD has 40. So you get more diversification with SCHD. Wow, and DIVO, it has very high turnover, 89% versus SCHD at 14%. Okay, so according to DIVO, the reason that you select DIVO is for income potential. You get those high quality dividend stocks with covered calls on the individual stocks. The active management allows the portfolio manager to identify opportunities and risks and act on those decisions in real time. And then they seek to lower volatility. Dividend and option income may provide lower share price volatility versus the overall market. Talk about funds or stocks, you got to talk about risks, right? So risk is inherent in all investing. Investing in the fund involves risk, including the risk you may lose all of your investment. Covered call risk is the risk that the fund will forego during the option's life. So if they have an option, you don't get the opportunity to profit from increase in the market value of the security if it goes above of the premium. So if the stock is trading at $10, they sell an $11 call. If the stock goes above $11, you don't get any of that upside in the stock because they wrote that covered call. Now, they don't always do it. They only do it when the volatility is high. So I like that better than just always writing them, which is what some of those other funds do. Okay, and then let's look at the actual risk numbers, right? Over the last 5 years or since inception, really the biggest drawdown in this, according to Morningstar right here, is 17.5%. 14.39%. That's in DIVO, and that happened during the COVID crash. If we jump over to SCHD, the biggest drawdown is 21%. So it looks like DIVO has been a little bit less volatile to the downside, okay? Let's look at the difference in the top 10 holdings of each of these funds, right? So for DIVO, if we look at the weight, you have 20% large cap value, 57% large cap blend, and then 20% large cap growth. If we look at SCHD, you see 32% large cap value, 41% large cap blend, and then you do get some medium cap in there, okay? So we see some differences between the styles of these two funds. SCHD is more value oriented, whereas DIVO has some growth exposure and less medium cap exposure. Okay, and now let's take a look at the top 10 and you'll see how different these portfolios are. At number 1 for DIVO, United Health, Chevron, McDonald's, Home Depot, Merck, Visa, Microsoft, Johnson & Johnson, UPS, Procter & Gamble, SCHD, Merck, Amgen, IBM, Cisco, Texas Instruments, Home Depot, Pepsi, Pfizer, Broadcom, Lockheed Martin. So you see 6 or 7 different companies in there and only like 3 to 4 companies similar in the top 10. All right, and finally, the big reveal, right? So looking at price return only, this only incorporates how much the fund goes up, does not incorporate the dividend. DIVO's up 30% over the last 5 years versus SCHD up 57%. But looking at total return, which incorporates the dividend, DIVO is up 74%, whereas SCHD is up 84%. So SCHD is still on top, right? But the question is, moving forward, which one stands to outperform? Okay, jumping over to DIVO, you can see price to earnings ratio 14.59. It is below the category average, right? Dividend yield 3.11 according to this, and then sales growth 8%, long-term earnings growth 11%, right? So remember 14.5, 11, and 8. And with SCHD we have 12.8, 7.6 long-term earnings growth, 16% historical earnings growth, and 7.69% sales growth. So my opinion, I like them both. Look at both of these funds and decide if you like the more active management of DIVO and more concentrated, or if you like SCHD, which has a more kind of systematic approach and does not write the covered calls, so you get that upside as well. There's a chance that with the downside that the market has seen, that if we do have a rebound, you want that upside from those stocks, right? But there's also a chance we go sideways for a long time, or we even go down, and in that case, DIVO could be better. So a perfectly good solution could be to own both or neither. The fact of the matter is just do your own research and decide what you want. I think both of these could be fantastic investments, or they could be bad investments. It depends on who you are and your own goals and what type of fund you're comfortable owning. Let me know in the comments if you own either of these, maybe you own both, and if you want me to review any more funds. Thanks.